The average person at home, you're looking at going, I don't know. You're better off shutting the TV off. Because when it gets to earnings, it gets even better. Just finished Q2 earnings, basically. 90% of the companies reported so far. We got a few more on deck. Oh, it's nuts. It's 75% of these companies reported positive earnings surprises. And you look at that and say, wait a minute. I thought we were in a recession. I thought things were 75%. That's higher than the norm of like 72%. So there's a large percent of companies reporting positive earnings surprises since Q3 2019 before COVID. How could that be? How could that be in this environment? Seems odd at first. Considering that Q2 earnings grew 7% year over year. And that's above the norm. Yes, we've seen 10, 15%, even 20% earnings growth after COVID. Pre-COVID, that was an amazing number if you're growing earnings 7%. In 2017, 18, 19, those are great numbers. 7%, holy cow. Again, looks great on the surface. When you take a look under the hood, earnings were not so great. You have the S&P 500, you take it as a whole. Just like you take the CPI, take it as a whole, and you go X food, X energy, because they're volatile, X this, X that. Love to do that. Let's remove this, and this to make everything seem all rosy and better. Even though, last I heard, we do pay for food and energy, right? I think we do. But we're going to remove that from the CPI, just so we get a better reading. Doesn't matter if that goes up like 5,000%. You're good. There's no inflation, right? That's what we're used to, which is funny, which is great. But let's take a look at the S&P 500 earnings. Because that 7% increase includes energy stocks. And energy stocks, I'm going to give you a second to guess this, maybe 2 or 3 seconds. How much do you think the earnings for energy stocks grew year over year from this quarter to last quarter? And yes, oil went through the roof. If someone would have told me to guess, I would have said 50%, 60%. It's 299%. That's the number. Fact set. That's how much earnings have grown within the S&P 500. Those earnings for energy stocks within the S&P 500, 299% year over year. Holy shit, are you kidding me? So if we take out energy, which we've seen, a lot of these energy stocks have come down sharply over the past 2 months, 3 months. Earnings are down for the S&P 500. They're down 4% year over year. So what does that mean? How come it's like, well, it means that analysts first did a great job significantly lower estimates into the quarter. I mean, if a company's projected to earn $1.25 for the quarter, and analysts lower those estimates to $1, which you don't see as an individual investor. Most people, they don't report when they're lowering earnings a little bit. They report upgrades, downgrades, and they'll show that number on the bottom of the screen. They beat earnings by this much. That earnings is the consensus earnings. That consensus earnings has gone down considerably into the quarter. So the analysts will lower that number from, say, $1.25 to $1 for a company, right? And you report $1.05 in earnings, and what does it say? This company beat estimates. They beat it by 5 cents. That's all you see. They beat estimates, and the stock might go up a little bit. At the end of the day, the numbers are the numbers. No matter what the analysts say, the numbers are the numbers of what you're reporting. And you're seeing earnings slow because you're supposed to earn $1.25, supposed to be a lot, but it's $1.05, right? That number, whatever the analysts believe is what they believe. That's what we trade on. I get it. I understand. That's what I do for a living. I track this stuff. For me, my job is to show discrepancies with sell-side analysts. Because if you could say if a company's going to report $1 and I see that they're going to report $1.50, the consensus, people think it's going to be $1. So I would recommend that stock saying these guys are way too conservative. Or vice versa. Maybe I say, short this stock because these earnings estimates are way too high. But at the end of the day, the number is the number. The earnings number is the earnings number. And you're seeing earnings slow, which is not a great sign, especially if your stock's trading at a high multiple. So even though we saw 75% of companies in the S&P 500 beat earnings to the upside, which is a great headline, and people are mentioning and talking about, yeah, you're celebrating it, it's not necessarily great news considering most of that came from energy stocks. And you don't have a huge following of energy stocks in the S&P 500. It's not this major component like technology is. It's not. But if you remove that, S&P earnings are down 4% year over year. Right? So let's use the formulas. It's so funny because you don't hear X energy when it comes to earnings, but you hear X energy when it comes to the CPI. Why don't we be more consistent? Let's be more consistent. Let's be real with people so we know exactly what's going on. That's why I listen to my podcast. But you wouldn't know that earnings for the S&P 500 Q2 year over year fell 4% by watching your favorite media channels. No way. All you hear is that 75% of companies beat. Things look rosy. Not a recession. Earnings are strong. No, they're not strong. They're down 4% year over year. They're not strong. Now look at the valuation for the entire S&P 500. We're trading at 17.5 times earnings. We're down to like 14. That's forward earnings. We're down to 14, which is insane considering on average, the 10-year average is about where it is right now, 17.5. So now we move back to the average sharply. And you're noticing in portfolio, your stocks are up tremendously since July 1st. But should we be at that average market multiple of 17.5 times right now with earnings down 4%? Again, taking one of the smallest components, the S&P 500, out of it, like we would do with the CPI. It makes you think we could be due for a pullback. And again, we traded the same valuation when earnings were growing 10% plus annually for years. Interest rates were 0. The Fed was aggressively buying bonds, and our government injected $11 trillion, which is insane. $11 trillion stimulus into the economy and kept going in 2021, even though oil asset prices hit all-time highs. And it's even funnier that they're still doing more and more spending. More spending. What is this thing called? The Inflation Reduction? I think we're going to spend more money, and it's the inflation reduction. It's getting to the point where the politicians are like, hey, all the people we're talking to are a bunch of idiots. Okay, they don't know they're idiots, but they're idiots. So let's just call it something, and we'll spend more money, as much money as we can, right? Do we really need to spend more money? Do we really need to hire more IRS people? Do we really need this right now? Really? Do we need to push this through? And congratulations to Manchin. What did he get? Holy cow, remember, he was the holdout on the Democrats. That guy probably has like 9 houses overseas someplace just to get that guy to reverse. Good job. That's what you need to do as a politician. Say no, 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 no. And then they're going to listen, we'll give you anything you want. You just need to say yes. Okay, yes. Right? It's great politics. It's awesome. But $11 trillion in stimulus. Now we're removing a lot of that. Should we be trading at the same multiple as a 10-year average right now? I would think it should be a little bit below that. Probably why short interest, if you notice, is starting to ramp up to the highest levels in months. Really ramping up here. That's why you saw Bed Bath & Beyond yesterday. AMC, GameStop, right? You're looking at the short interest. Look for Bed Bath & Beyond. Short interest was 15% in May. It went up to 35%. It was 35% 2 days ago. And what happened? Ape said, it's time for the short squeeze. Talk about Bed Bath & Beyond surged 30% plus. A lot of that is short covering. So when you see this massive shorts piling in, again, in order to get out of that position, you have to buy. So if that moves the wrong way, you're forced to buy the stock at whatever price. The stock's at 20 and you're short and it goes to 25. You're like, I'm out of here. In order to be out of here, you got to continue to buy, which means it's going to go to 27, 28. And then the rest of the shorts are going to be like, holy shit, I'm getting buried. I got to continue to buy. And that's where the short squeeze is. It goes higher and higher. Look at Bed Bath Beyond, AMC, GameStop yesterday. You only see those types of moves when you have big short positions because you're forced to buy. Just like we saw in Bitcoin, just like we saw throughout the crypto industry, in small caps, especially in biotech, was the opposite. When you're forced to deleverage, you're selling stocks no matter what price they are because you need that money. You're not looking at valuation and saying, oh, this stock went from 80 to 10 and I'm going to wait for it to come back. No, you need to sell it and get out of it. And it brings it down to 8 to 6 to 4. And that's great for individual investors. That was a great time to buy 8 weeks ago, 9 weeks ago. But we've come up tremendously since then.